Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so let's set the stage. Thursday, February 5th, Hub Group closes the day at $51.33. The charts look clean. The company's riding high. I mean, it's basically hitting 52-week highs. It looked for all the world like the darling of the mid-cap logistics sector. Then Friday happens. The sun comes up, the opening bell rings, and the stock just gaps down violently. Opens at $37.72.
That is a 27% haircut in a single session.
Exactly. We're talking about over $800 million in market value that just evaporated before most traders even had their first cup of coffee. The volume was massive. You could just hear the institutional exit doors being smashed open. And the catalyst? A disclosure that they misplaced, accounting-wise, $77 million in purchase transportation costs. It is a massive, massive hit. The market is reeling. But here's a question we need to answer today. Is this a death blow that makes the stock uninvestable? Or did the market just hand us a generational entry point into a critical piece of North American infrastructure at a fire sale price?
Wow. Generational entry point? You are starting off incredibly optimistic. When I look at that chart, and more importantly, when I read the 8K filing that dropped on Friday, I don't see a discount. I see a structural break. You just cannot invest in a logistics company, or any company, frankly, if you cannot trust the numbers they print. This isn't a bad quarter because of a snowstorm in the Midwest or a port strike in LA. This is a fundamental failure of internal controls. They effectively admitted that their profitability for the first 3 quarters of 2025 was, well, an illusion.
Illusion implies there's nothing behind the curtain, and I have to disagree with that characterization. Look, I get it. The phrase material misstatement is terrifying. It absolutely triggers algorithms to sell instantly. That's that de-risking we saw Friday. But if you stop looking at the red tape for a second and look at the actual business, the picture really changes. Management was explicit in their statement. The $77 million error impacts reported income, yes, but it does not impact total cash equivalents, or operating cash flow. The cash is physically in the bank. The business is generating liquidity. They aren't burning furniture to keep the lights on.
But knowing you have cash in the bank isn't the same as knowing if your business model actually works.
But the model is working. I mean, before this drop, the stock was at $53 for a reason. They acquired Martin Transport's intermodal assets. Their cross-border business in Mexico is absolutely booming. My argument is that the engine is intact. The stock is now trading near its book value. For a patient investor, this is the definition of value investing. You buy a good business when it's sitting in the penalty box and everyone else is too scared to touch it.
I'm sorry, but you can't say the engine is intact when the dashboard gauges are broken. Let's look at the reality of that $77 million. You mentioned it doesn't affect the cash balance, fine. But it absolutely incinerates the margin narrative. If you adjust for this error, Hub Group's operating margins for those first 3 quarters of 2025, they collapse from a reported healthy 4.4% to a razor-thin 1.4%.
That is a backward-looking metric, though.
It's the metric that matters. Margins are the scorecard. A 1.4% margin means the freight recession of 2025 nearly killed them, and they didn't even know it. They were running trucks and trains thinking they were making money, but they were barely breaking even. The company is, in my view, uninvestable until a full forensic audit confirms where the earnings floor actually is. We don't even know if this rot goes back to 2023 or 2024 yet.
I think uninvestable is hyperbolic for a company that's this essential to the supply chain. But let's dig into the error itself so the listeners understand what actually went wrong. We are talking about purchased transportation costs.
Right. And we need to be crystal clear on what that means because it sounds like jargon, but it's the whole business. Hub Group is asset light. They don't own the train tracks. So purchase transportation is the fee they pay to their rail partners, Union Pacific, Norfolk Southern, and to the drayage trucking companies to move the goods.
And drayage being the short-haul trucks that move the containers from, say, the port or the railhead to the warehouse.
Exactly, that first and last mile. For a company like Hub, that is the single largest expense category. The fact that they missed $77 million in accruals there means they didn't realize they owed money to their biggest partners. That suggests a profound disconnect between operations and accounting. It implies that for 9 months, management thought they were making a decent profit on loads where they were actually losing money.
I am not defending the accounting department here. The controls failed. There is no debating that. But you have to separate the accounting mechanism from the strategic position of the business. Let's pivot to the Intermodal and Transportation Solutions, or ITS segment. That is 60% of their revenue. While everyone is panicking about the spreadsheets, they are missing the strategic pivot, the Martin integration.
The acquisition they made back in, July 2025?
Yes. Hub Group dropped $51.8 million to acquire Martin Transport's intermodal assets. This added 1,200 refrigerated containers to their fleet.
It's an acquisition. I mean, companies buy assets all the time. Why does this save your thesis?
Because it changes the mix of what they haul. Standard dry van shipping, moving boxes of toilet paper, electronics, furniture, that's a commodity. It is a race to the bottom on price. If you charge $1 more than the next guy, you lose the load. But reefer, or refrigerated shipping, is specialized. It's food and beverage. It's sticky. You can't just throw frozen chicken in a standard container sitting in the Arizona sun.
Sure. Okay. The barriers to entry are higher.
Exactly. Martin's assets allowed Hub Group to increase their reefer volumes by 150%. So while the dry van market is soft, their reefer business is growing. At the same time, their cross-border intermodal business into Mexico is up 33%. They are capitalizing on nearshoring, factories moving from China to Mexico in a way that very few competitors are. They are diversifying away from the commoditized freight that gets crushed in a recession. The accounting error hides the fact that the actual quality of the revenue is improving.
The quality of the revenue might be improving, theoretically, but again, if the cost to service that revenue is understated, the margin profile is still garbage. It doesn't matter if you're shipping diamonds or coal. If it costs you $100 to ship it and you only charge $101, you're in trouble if you miscalculate your expenses. And let's talk about how Hub Group stacks up against its peers. You want to make a value argument? Let's look at the valuations.
I'd love to, because if you look at the sector, Hub Group is now trading at a massive discount.
It's a discount for a reason. It's the cockroach theory. Where there's one accounting error, there are usually more.
Let's compare the numbers, though. J.B. Hunt, JBHT, is trading at roughly 35 times earnings. Knight-Swift, KNX, is trading at over 60 times earnings because investors are pricing in a recovery that hasn't even happened yet. Hub Group, prior to this crash, was trading around 29 times trailing earnings. Now, it's significantly lower. You are buying the same macro recovery exposure as Knight-Swift, but at a fraction of the multiple. You're getting the containers, the tractors, the relationships, all for pennies on the dollar compared to JBHT.
That comparison is dangerous because you are ignoring the efficiency gap. J.B. Hunt is the gold standard in this industry. They boast a return on equity, an ROE of 16.33%. Do you know what Hub Group's was? 6.58%.
That is the significant gap, I grant you. J.B. Hunt is a machine.
But hold on, that 6.58% for Hub Group was based on the inflated earnings before we knew about the $77 million hole. If you restate the earnings, the real ROE is likely abysmal, maybe 2 or 3%. And another thing, size matters. J.B. Hunt is a $19 billion behemoth. Hub Group has fallen to about $2.7 billion. Smaller players are just more vulnerable to shocks. And regarding the PE ratio you cited, the E in Hub Group's PE is currently unknown. We literally do not know what their earnings are until the restatement is filed. Saying it's cheap on a PE basis is a mathematical fiction right now.
You're focusing too much on the trailing numbers and missing the windshield view. The market is forward-looking. And looking forward, there is a catalyst here that is bigger than a quarterly accounting restatement. We have to talk about the rail merger, Union Pacific and Norfolk Southern.
The proposed transcontinental railroad.
This is a generational shift. The merger application was filed late last year. It creates the first single-line service from coast to coast. Why does this matter for Hub Group? Because Hub Group is a primary partner for both UP and NS. Currently, if you want to move goods from Los Angeles to New York by rail, you hit the Chicago black hole.
Gateway friction. It's the bane of every logistics manager's existence.
Right, you have to offload the container in Chicago, truck it across the city through gridlock traffic, which is expensive drayage, and load it onto a different train. It takes time, it costs money, and it's where delays happen. This merger eliminates that. It saves 20 to 95 hours per transit.
That is the pitch, certainly.
It's not just a pitch, it's a mathematical reality of the network. By shaving off that time, rail becomes competitive with team driver trucks. They are estimating this will convert 2 million truckloads from the highway to the rail. That is a massive addressable market for Hub Group. If you hold this stock through the current accounting mess, you are positioned to ride the wave of the first true transcontinental railroad in U.S. history. That strategic value doesn't just disappear because an accountant missed an accrual in Q2.
That is a compelling narrative, but have you considered the execution risk? Railroad mergers are notoriously messy. Remember the service disruptions we've seen in past Class 1 consolidations? Terminal congestion, lost containers, confused scheduling. In the short term, this merger could actually hurt Hub Group's service levels before it helps them. And that's all assuming the Surface Transportation Board even approves it without massive concessions.
The friction is temporary. The structural advantage is permanent.
But Hub Group has to survive the temporary to get to the permanent. And the macro environment isn't helping. We are looking at 2026 still facing labor shortages. Driver turnover is over 90%. The macro environment is described as stable, but not surging. A stable market isn't enough to lift a company that just admitted it doesn't know how much it costs to run its business. And speaking of trust, we have to address the elephant in the room. The CEO, Philip Yeager.
I figured you would bring up the insider sales.
How can I not? This is a massive red flag. Philip Yeager sold 32,000 shares in December of 2025. That's approximately $1.4 million. This sale happened just weeks before the accounting error was discovered.
Well, executives sell stock all the time. It's part of compensation. They have 10 B51 plans set up.
Timing is everything. He sells $1.4 million in stock, and less than 2 months later, the stock crashes 27% because of an error that was occurring while he was selling. I mean, Hagens Berman and other law firms are already circling with securities fraud investigations. Whether it was malicious or just incredibly unlucky timing, it destroys credibility. If the CEO is dumping stock right before the bad news hits, why should an outside investor be buying?
We need to be careful about assigning malice where there might just be standard financial planning. The Yeager family has led this company since its inception. They are deeply invested. David Yeager, the chairman, has been gifting and selling for years for estate planning. And let's not ignore the other side of the ledger. Drew Bonsall, the CIO, he received a significant award of restricted shares in January. If the house was really burning down, would they be issuing equity to key execs?
Stock awards are different from open market buying. Awards are just paper until they vest. Sales are cash out the door. The CEO took chips off the table. That is a fact.
But look at the institutional support. BlackRock still holds 14.3%. Dimensional fund advisors actually increased their stake to 6.7% mid-last year. These aren't retail day traders. These are sophisticated funds that see the long-term value. There's churn, sure, but the big money hasn't abandoned the ship. They understand that insider selling happens for tax reasons, for diversification. To pin the entire thesis on one sale by the CEO is ignoring the broader ownership structure.
I disagree. In a crisis of confidence, the CEO's actions are the only signal that matters. And the signal was sell. But let's ground this for our listeners. Let's say someone has $5,000 to invest right now. They are looking at that $37 to $40 price tag and thinking it looks cheap. What happens to that money?
I'll take the Bullis case. You put that $5,000 in today. You are buying a company that generates billions in revenue, is a critical partner to the largest railroads in the world, and is trading at a crisis discount. In the short term, it might be rocky. But look at the long term. If they fix the internal controls, which they will because they have to, and the freight market tightens in late 2026 as projected, you get a double whammy. You get the earnings recovery, and you get the multiple expansion as the trust returns. That $5,000 could easily double if the stock just returns to its previous highs of $53 and then benefits from the rail merger synergies. You are buying a dollar for 50 cents.
You are buying a value trap. Here's my scenario for that $5,000. Short-term, high volatility. The stock is in the penalty box, likely trading sideways in the $39 to $42 range, but there is a trap door. If the audit reveals that the errors go back to 2023 or 2024, we see another leg down to $30.
You think it goes lower?
Absolutely. If the rot is deeper than just 2025, the trust evaporates completely. Midterm, that money is dead money. Legal costs from the class action lawsuits are going to weigh on earnings for at least 18 months. Management will be distracted by depositions instead of focusing on strategy. You might see that $5,000 whittle down to $3,500 before it ever sees $5,000 again. There are simply easier ways to make money in this market than betting on a company with broken accounting. Why catch a falling knife when you can buy JB Hunt and sleep at night?
That's the classic fear response, but dead money is often where the best returns are incubated. The legal costs are one-time items that get backed out of adjusted earnings. The market looks through that. The core issue is, are they moving freight? Yes. Are they getting paid for it? Yes. Are they growing in Mexico? Yes. The disconnect between the stock price and the operational reality is the opportunity.
But are they making a profit moving that freight? That is the question we can't answer right now. And until we can, Hub Group is effectively a black box. You are asking people to invest on faith, and in the stock market, faith usually gets you killed.
And that brings us to the core of the disagreement. You see a black box, I see a mispriced asset. The asset base alone, the containers, the drayage fleet, the technology, provides a floor. Even if you broke the company up and sold it for parts, it's likely worth more than the current market cap.
I see a company that has lost the privilege of the benefit of the doubt. The $77 million error is a fact. The margin collapse is a fact. The CEO selling before the crash is a fact. Until the restated 10-Qs are filed, and we know if this rot extends back to 2023, the risk of capital loss is simply too high. Investing is about risk management, and right now, Hub Group is unmanageable risk.
And I see a market that has thrown the baby out with the bathwater. The cash flow is real. The Mexico growth is real. And the rail merger is a game changer that no accounting restatement can stop. This is a painful moment, absolutely. But history shows that buying major logistics players when they're on their knees is usually a winning strategy. The business isn't going away. The demand isn't going away. Only the stock price has collapsed. That is a buying opportunity for those who can stomach the volatility.
We can agree on one thing. The immediate future depends entirely on the upcoming audit results. We need to know if $77 million is the ceiling of the damage or if it's just the floor.
Agreed. It all comes down to the numbers. We'll be watching the filings closely. That does it for this deep dive into Hub Group, a complex situation with high stakes on both sides.
Indeed. Proceed with caution.
We'll see you next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.